Investors are worried about an economic downturn, perhaps even a recession, and who can blame them? The stock market is coming off 2 blistering years, and the headlines from Washington are hard to ignore. But let me tell you something, trying to time the market is a fool's errand. Don't fall victim to fear-mongering or try to predict when you can prepare instead. Remember what the great Peter Lynch once said, "Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves." Before we get into the nitty-gritty of what you should, or shouldn't, do with your finances if you expect a recession or market crash, let's zoom out and get some long-term perspective. Markets and investors have notoriously short memories, but the US economy and markets have overcome many periods of uncertainty and economic pain. Remember the dot-com bubble, the financial crisis, COVID? We got through them all, and we came out stronger on the other side. So take a deep breath and remember that this too shall pass. Look, it's important to understand that every economic cycle ends in a recession. So if we're not in a recession technically, we're always getting closer to one. Since 1950 there have been 11 recessions lasting 10 months on average. That's like clockwork, folks. But here's the thing, recessions are a natural part of the economic cycle. They cleanse the system, weed out the weak, and set the stage for the next bull market. Chapter 3. Let's talk about market sell-offs. There are many terms to describe pain in the financial markets. Bear market, correction, market crash, sell-off, dip, and so on. Although some of these terms have meaning, the point is that markets go up and down every day. But the longer you invest, the more likely you'll make money. Investors also may not recall how much stocks tend to fluctuate each year. In fact, the average intra-year decline for the S&P 500 is over 14%. But despite short-term sell-offs on a calendar year basis, the stock market has historically been positive 75% of the time. Chapter 4. While not an exhaustive list, these are some key financial planning items everyone should tackle. Keeping the right amount of cash. Cash is always a hot-button issue. Investors almost always have way too much or far too little. As a general rule, one-income households should have 3 to 6 months of essential expenses in a savings account, with 2-income families needing at least 3 months. Not having enough can be disastrous if caught flat-footed. Having too much is no way to build wealth. Check how you're invested. As far as investing goes, bad ideas include going to cash out of fear and making changes solely because you're hypothesizing, insert concern you can't control, is bound to happen. That said, it is important to periodically review your accounts to ensure you're properly diversified and are taking on the right amount of risk. Diversification isn't a magic bullet, but it's typically the best defense in volatile markets. Bonds are typically a ballast in a portfolio, and they tend to perform well during recessions. There's a lot that goes into a proper investment strategy, but one major key to success is about time in the market, not timing the market. Chapter 5. Bottom line, we can't protect ourselves against every unknown or prevent life's certainties from happening. But if you do the work, stay on top of it, and build in enough margin for the uncontrollable, outside events shouldn't have an outsized impact on your life. Navigating economic uncertainties like recessions and market downturns requires a shift in focus from prediction to preparation. Instead of attempting to time the market or the recession, strengthen your financial foundation. By concentrating on the controllable aspects, you'll be in a better position to weather any financial storm and achieve long-term financial stability. Outro. Listen up, because I'm only going to say this once. Recessions are a fact of life, but they don't have to derail your financial future. Remember, bull markets climb a wall of worry, and bear markets slide down a slope of hope. So don't panic, don't try to time the market, and for heaven's sake, don't listen to the chicken littles running around with their heads cut off. Instead, focus on what you can control, your savings, your investments, and your long-term plan. Stay the course, stay diversified, and remember that in the long run, the market always goes higher.